Welcome to Lincoln News with your host, David Lincoln.
I can see you, yeah.
Okay, I'm sorry for my appearance. I always look this way though, so.
That's fine. It's great to actually see you in person. That's great. Yeah, so have you been staying in hotels a lot lately? Or are you sort of on vacation?
Yeah, it's kind of my life. I do a great deal of consulting work around internationally. Some of my clients are AB InBev in Belgium, Coca-Cola here, Pepsi, Nestle in Switzerland, a couple of companies in, manufacturers in Asia.
Wow.
So I've always, the last 7-8 years, I've done extensive traveling, and my suitcases. I always get the suite with the two queen beds, so my suitcase and stuff stays on one bed and I'm on the other.
Nice. Yeah, I recently went to a big bachelor party weekend, so I got to stay in a suite for a while, which was pretty fun. I'm watching UVXY as we talk here. Looks like it's in a safe zone for the time being.
But we got the VIX down pretty nicely today. Futures are following. The only thing I'd like to see pick up a little bit is M2 falling a little bit, and even M3, just because we are getting towards 75% of the holdings. So we may just kind of level out again.
I get the feeling that maybe the futures guys are a little spooked from the the whip back from yesterday a little bit, and so they're a little hesitant to take it down after it just whipped right back in their face yesterday. At least that's my read on the on what's happening right this second. I find you to be a fascinating character because I think Wall Street doesn't quite know what to make of you because you've had this huge amount of success, and your strategy, once you explain it to people, like some of the best strategies out there, is fairly simple in concept. And so I think a lot of these guys are kind of kicking themselves like, why didn't we think of this one?
A lot of them, because they manage, high dollar amount assets. Their first kind of necessity is risk management. So they don't ideally prefer the notion of risk management along the lines of liquidity or just general cash consumption. What they've typically done is, in this particular market cycle, is just tax themselves. They've hedged their volatility exposure, which has proven to be nothing more than a tax on the profits from their volatility exposure. So they didn't really, it wasn't very capital efficient. So that's, some of the work that I've been doing, like with Goldman Sachs and some of the other banking institutions and hedge funds is, it's not just the implementation of risk management, it's rationalizing that risk management when you juxtapose it to the current economic cycle.
Now, were you interested in the stock market and financial markets as a kid? Yeah. When did your interest first start?
No, I was a soccer player. I grew up playing soccer. From like 7 years old, I would play city leagues and then in traveling leagues. I played for my high school, and unfortunately, in my junior year of high school, I was invited to the men's under-17 national team.
Oh, wow.
U.S. national team. I had scholarships all over, the U.S., all the big, major schools that were popular in soccer. But then, after practice one day in high school, and my buddy and I, we were going to go into the student parking lot, and somebody just opened fire on the school, came through with like a low rider, just all the bass pumping, and all we heard was just like a machine gun.
Are you kidding? Wow.
We just fell to the floor, and when we didn't hear anything else, and we saw the car go away, we rushed into the student parking lot into the car, and we just took off. But I didn't realize it because I had so much adrenaline pumping through my system in that situation. But I kept wiping the back of my leg, my right leg, because we had just finished practice. I just thought it was sweat.
Oh, you got hit?
So yeah.
Wow.
When I went to turn the radio in his car, my buddy's car, my whole palm was just red, and that's when I realized that I had gotten hit. And he rushed me to the hospital, called my dad, and fortunately what happened was it was a ricochet, because there's double steel doors that you come out of the school building before you get onto like the sidewalk area, and that's where we went down, but it must have hit the steel doors and came into the back of my leg, traveled up to my hip.
Oh, jeez.
To the other side and came out the other side, or at least pieces came out the other side.
Oh, jeez.
All kinds of nerve damage as the bullet traveled. So I had like 18 months of physical therapy. I lost all my scholarship opportunities, and just the range of motion was never the same. I'm still, I can still run, jump, and do it. But,
well, that's good.
It took a long time to actually get, the full range of motion and feeling back.
Now, were you in school was that in Florida that you went to school?
Yeah, this was Miami-Dade.
Okay, Miami-Dade, yeah.
Not exactly the best, best school districts in the country.
I'm a huge fan of the first 48, and they always have people from Miami-Dade in that one. So how does someone go from working at Target to being like one of the most popular analysts and requested by all these people to give advice? How did that transition occur for you?
Let's see. So I went to Florida State University. I got my first degree in English education. I was going to be a teacher. I like kids. I liked educating people. And I have a fondness for the English language. Just I used to love Chaucer and Shakespeare, and just big fan of Emily Bronte and all those works. And I've just been a constant reader, all my life. And I wanted to basically, be a teacher and educate children on grammar and how, because it's so important when you're getting your degree. You have to accumulate so many words in reports to get your degree, no matter which one it is. There's standards now that you have to write so many reports, and they have to constitute so many words. And so I wanted to kind of help students to ease through that process, because if you can't grasp the English language, the grammatical sense, you're going to struggle in college, unfortunately, because you have to take the humanities. You have to do English 1101, 1102, composition if you want. But so I was going to be a teacher. I taught for about a year and a half. Going through college, I pretty much put myself through school, working at the Sports Authority. I was the shoe guy in the shoe department, and I really enjoyed that. I enjoyed just the people, your colleagues, and every day somebody would come in, and it was always in retail. No 2 days are alike. There's always something different every single day, and I just like that. So I taught for a year and a half, and I disliked it.
Really?
Kindly or generously. I really disliked it. I was teaching in Broward County, which is the next county north of Miami-Dade. But
okay.
it's still one of the worst, districts in the United States. You got D.C., Baltimore, some districts in Los Angeles. But Miami-Dade, Broward are just, it's because of, it's a melting pot. You have so many different people from all different cultures, and all, some, you have a lot of different, the students that I taught were ESA students, so a lot of them, I was ninth grade remedial.
What does ESA mean?
They have learning disabilities.
Oh, okay.
Emotion handicap. Some of them don't speak English. I'm bilingual. So I would get kids that literally were in the country for a week from Cuba or Haiti or other countries, Venezuela, Mexico, and they don't speak a lick of English. That was my classroom. Those types of students trying to learn on a ninth grade reading level, where most of them, were at maybe fifth, fourth, sixth grade reading.
Yeah, that sounds tough. Yeah, my mom was an ESL teacher, and I was English major too. Yeah, so that didn't work out after a year and a half for you.
I decided to go back to retail, and I started working at Bed Bath & Beyond, and then a recruiter from Target had come into the store, and as a Bed Bath & Beyond manager, you're supposed to greet everybody, every customer you're supposed to greet, and this particular customer, when I greeted them, I said, "Can I help you find something?" And this person said to me, "Yeah, I was looking for you." Okay. And he gives me his card. He was a recruiter from Target, and 2 months later, I'm working at Target, in the logistics operation. And I was at Target for a good, 8-9 years, and Target had a fantastic program where if you take advantage of it, they'll pay for a third of your higher learning, your college tuition. So that's what I did. And I was working 50, 60 hours a week at Target and going to school taking 12 credit hours each semester, which was, it was tough, but.
Oh, yeah.
Yeah, absolutely. And, I took courses in finance, economics, business administration, even law. I actually wound up getting my degree in law, specializing in labor and employment, because at that time I thought that would be the big concentration, just due to unionization, new rules that were coming. This was kind of during when the President Obama administration was coming in, and that was kind of, what everybody was going to was labor and employment law. So I did too, thinking the same thing.
You said you're bilingual in Spanish, so with your Spanish, that would fit you perfectly. It sounds like, with people coming into the country and stuff like that. Sorry, I didn't mean to interrupt you. I was curious as to which language you were bilingual with. So.
Yeah, I can speak a little bit of Creole, just because we do have a large population of Asian-born
nice
folks in Miami-Dade area. But yeah, more fluent, obviously, in Spanish. But my fancy was finance and economics and the markets. That's what I gravitated toward. I just found I had been investing, all this time. Yeah, a little bit of money there. I had bought my first home in 2003, and of course the market just went, skyrocketed in 2004, 2005, where I was buying more homes and flipping them, and condos and flipping those. Money. But so far as actually getting into the markets, that probably started in 2000, just trading Starbucks. I was just a day trader.
So, only Starbucks.
2001. I knew Starbucks. I like Starbucks. I saw the lines at Starbucks. So I said to myself, this is going to last. This is a good company. They're popping up all over the place. I'll just day trade. And back then I was just hoping to make $100, $200 a day. And if I achieved that on a nice, 40 cent hard to time it as a day trader, and it's a very emotional process. I was always either leaving money on the table or finding myself, having to hold on to it for a little more time than I actually expected. And, that's when it kind of dawned on me, I need to expand, what I'm doing. There's got to be a reason why I'm always leaving money on the table or entering too early.
Now, what year was that? Around 1990, did you say? Or when was? 2001. Okay, got it. Okay.
And I mean, it was like, I don't know, $18, $19 a share back then. And that's before, I think it's reverse split 2 or 3 times since then. Yeah, it was just day trading, but I was making money. I just felt like there was another level I could achieve. And so when I was at Target, I started, when I was in the finance and economics classes, you also take, general, there's 3 courses that I was able to take dealing with the equity markets and the bond markets. And that's when I learned about, hey, you should read 10K filings and quarterly transcripts. And that's when I, kind of like the light turned on, and I realized, the emotional aspect of day trading wasn't really worth it, long term, because if you can read a transcript and you follow a company long enough, you trust in what you're doing because it's validated in what you're reading in these quarterly transcripts and disseminated by the management team. So
it's more evidence than just a feeling or something like that. Did you have a specific person or book or class that turned you on to day trading the markets? How did you get the idea to start day trading? Because that seems like a...
And I followed the herd, to be honest. I followed the herd. Plus, my grandmother was losing a ton of money at that time. She was like in her 80s.
Okay.
And back then there was A.G. Edwards. I don't know if you remember.
I'm familiar with that, yes. Yeah.
Okay, yeah, they got bought by First Union, who eventually got bought by Wachovia, who eventually got bought by Wells Fargo.
Okay.
But all the way back then, she had her portfolio being managed by A.G. Edwards, and when the dot-com bubble burst, it took everything down with it for a period of time. And I remember, because I would always go, she was alone. Her third husband passed away, and I was the only one that, I didn't take care of her, but I was the only one who would visit her. And I would go every Saturday to take her to the grocery store to buy her groceries for the week, and then to her favorite pizza restaurant, because she just, and that was, that made her week. So I would do that literally every Saturday.
So did she have like an A.G. Edwards broker that sort of set her in the right direction or something like that? It's interesting you say that because my grandmother was the same way. Like she was, her husband died, and as she got older, she had these investments. So it's very similar to yours information. So did you sort of take over her investments from her broker in a way?
So I saw over a period of like 6 months, I saw several statements, and I remember these, like there's, I can read it from the back of my hand today. And I remember at one point it was $900,000, and then the next one I saw was $800.
Uh-oh.
And 7 and 6. It got all the way down to like 300,000. This can't, so I convinced her to set up an appointment with us and her, her portfolio manager, so that we could speak to him and see what we can do to put this back on the right track. But then even before we actually got to the meeting, because I wanted to speak intelligently about, what we should do, I decided to look at all of her holdings and, her gains and losses and things like that. And I realized this person, portfolio manager, had her in mutual funds that she had no business being in at her age. It was kind of ridiculous. And when I kind of, asked around and everything, I learned about the commissions that these, asset managers would capture if they sold certain mutual funds.
that made them the most money. Yeah, right.
Disillusioned me a little bit. And, so we went into that meeting, and I just wanted her out of everything, and out of that particular brokerage as well. So I had asked them to, liquidate all of her assets and send her the check, and they did. And that's what they did. And she wound up with like $475,000 after what I paid of $900,000. First time.
Yeah.
I tried to, basically I put her into some, she's an older woman. I put her into some high yielding CDs that were, at that time, 7+%. So we put her in a bunch of those, and I set up an account with Scottrade all the way back then, with just, $50,000 for her. And, I was on the account, and, I was trading off of that, and I was able to grow that, over the next 3-4 years, to roughly 250,000 or so. And then unfortunately she passed away. I was the only, person that she cared for to the extent she cared for people. And she left most of, her assets to me, for which I had no other parents. So I was raising my brother and my sister. So I put my sister through college with that money. I got my brother a vehicle, so he started his electrical. He was becoming a journeyman electrician. I wanted to make sure he had transportation and everything. And of course, just paying for the mortgage. We all lived in the same room at that time still, before going off on our own ventures and getting married and starting families.
Wow. So wow. You it sounds like you really saved her. I mean, that thing could have gone down to zero. It sounds like it was down 50%.
Yeah, it was terrible. I just, and we have some laws that kind of prevent, some of that, some of those type of dealings where asset managers are actually, back end filled or paid under the table from, commission wise for selling assets, selling mutual funds or selling, municipal bonds to people that they have no business being in. So, yeah, but from Target, kind of back up, I had done really well in my career at Target. It was very well thought of. I had advanced from, just a general manager inside of the store to a district logistics manager, facilitating the processes for the entire district. It just came to a time where you can only work so many 60-hour weeks.
I feel that one.
Yeah, and I was doing really well. What I was considering, a private business that I would eventually take public, investing my own money, and, I was beating the market every single year. I felt really good about my ability to analyze, particular business models and forecast for the future. And a couple of gentlemen came to me with the idea of starting our own research, a boutique research firm. And that's what we did. It was called Capital Ladder Advisory Group back in 2011. And we would basically sell white paper research and general research reports to the hedge fund and portfolio managers around the country.
Now, was that through Goldman Sachs? I saw something about a relationship with Goldman Sachs with you earlier on.
No, this was private. This was my own business. I had taken an internship with Goldman Sachs that didn't work out well. I tell people I was let go. We had a difference of opinion. This was 2011, and if you recall, in 2011, it was BlackBerry versus iPhone in 2011, and the analyst at that time who was covering the handset makers for Goldman Sachs was leaving, and I had the opportunity to actually take a full position there as a junior analyst. But all the research that I did on BlackBerry, let me back up. Goldman Sachs had a buy rating, and they were going, the stock was $65, $66 at the time, and they were actually going to give it a triple-digit, the first triple digit, rating and price.
Yeah.
This was back when it was crack. It was the smartphone. But all the research that I was doing, I literally, I traveled to China. I visited, some of the suppliers for the different components. I went to Canada. I met with management. Again, back the old management back in 2011. Everything I found said we have problems here with this company. And of course, if you're going to analyze, one handset maker, you have to analyze the competition. So I was analyzing Apple back then as well, and what was dropping off of the face of the earth, which was Palm. That was kind of the number 3 dog in the race, if you will. And Samsung was an up and comer from the Asian market. There wasn't as much data back then that I could gather, as much research that I could. Being a South Korean company, I didn't have those relationships, so there wasn't much I could do there other than visually see and follow, of course, those data tracker agencies like IDC and Garmin. But everything that I came up with said nothing that BlackBerry was doing at the time would maintain their market share. Okay? And of course, Goldman has these huge clients. They just have huge clients, and that they're disseminating to had a 30 or 40 page report, and I thought I was doing awesome. I had all these graphics, and it looked real pretty, and it was really analytical. It was foresight, it was everything in between, and I handed in thinking, this will, get me over the
next level, yeah.
Yeah, and I just got blindsided. Basically, I didn't realize, how the industry works, and this was not what they wanted to see. I basically said it's a sell. My conclusion was it's a sell, and I had a $42 price target on it.
So they wanted you to basically rubber stamp it as a buy. Is that what they wanted?
Yeah, pretty much. And so, they let me go, and I went and we started a Capital Ladder Advisory Group. Shortly thereafter, the only reason Capital Ladder Advisory Group was actually able to move forward is because, the 3 partners came to the firm with, very little reputation, very little marketability, but we had some capital, bringing $100,000 just to invest into this venture. And we got to a point where, we only had a couple clients. I mean, like 2 or 3 clients buying our research at the time, and we're basically low at running low on capital to push this forward. And I said, why don't we just bet on BlackBerry, and parlay the money? And I gave all the research to the other 2 partners, and they agreed.
You mean going short BlackBerry?
We shorted BlackBerry all the way from $66 to the price target of $42.
Wow.
Which only took about, I think, 9 months.
Now, I don't know much about research companies. How did your company make money? Would you be on retainer to different companies, or would you sell stuff by the paper, or how does that work?
Yeah, a lot of our business was consulting related.
Okay.
Retainer agreements, as you say, and the actual research. These would come to us in Apple, or in BlackBerry, or in Target, or companies like that. That we advertise as CPG, retail, and consumer product goods back then. And so they would come to us, and they would want a full-scale research report, on these companies. And then, a good research report can take anywhere from 30 to 60 days.
And how much does one cost in general? I mean, not specifically, but I have no idea ballpark of how much that sort of thing costs.
Ours were premium. We generated a premium above and beyond the likes of KeyBank or Oppenheimer, Stifel Nicholas. Like, their reports are anywhere from a couple $100, but you're talking about mostly numbers. There's not a lot of analytics in there. My So their reports are anywhere from 3 to 5 pages, and most of the final pages are like the big chart that shows you the breakdown over 3 years. The 3-year forecast.
Okay.
And that can take a couple of pages, and then their disclaimer. But the actual verbiage that makes a person feel comfortable about investing, that actually analyzes everything that's going on in the company, maybe only a couple paragraphs in those institutional reports.
Okay.
I would generate something that on just the verbiage of our research reports could be anywhere from 8 to 12 pages. And then would come the charts, the breakdown of different, sales segments, and of course, the 3-year CAGR or, forecast for EPS and sales.
That's the meat of the whole thing, in your opinion, is the actual analysis, other than just raw numbers. That makes total sense to me. Yeah.
Right, and our efficacy rate for a thesis was over 75%. So basically, if we said it's a buy, a hold, or a sell, and set a price target, 75% of the time or better, that is actually what happened.
That's a great average. I think a lot of these companies are underwater with their averages. It seems like. Are companies rated based on their averages, or is it just sort of a general reputation thing?
I think both. For us, it was reputational. We were a small boutique, research firm out of Miami, Florida. There's no research firms in Miami, Florida. So for us, it was very much word of mouth and just networking. Part of my job, and I didn't really consider it a job because I loved doing it, was to go to all the different conventions, around the country. And there's like dozens and dozens of different types of conventions, whether they're investor-driven conventions, consumer home product conventions, you name it. And so I would go to those, and I'd meet just all kinds of different people. But in general, I would say the hedge funds are very much connected. They tend to especially in the same state, they'll help each other out because they know that their business relies on word of mouth and performance. And sometimes they just don't perform, and their clients will leave and go to another hedge fund. But it's kind of, they go back and forth, so they help each other. Well, I lost one and they went to you. If you lose one, can you at least recommend me?
It's a small group in the end of people. Yeah. So I was watching that show Billions. Have you seen that show? It's about a hedge fund manager in New York. Well, that's about all I know about that insular world. So what are some of the biggest conferences every year that analysts go to?
They all go to the International Home and Houseware Show in Chicago in March. It's one of the biggest, consumer product show every year. And the Consumer Electronics Show in Las Vegas, which is generally in January every year. They go to that one. And then there's just the big seeking, the alpha conferences, and the a lot of the, like on CNBC, you see the Seeking Alpha conference. They all go to those and they pitch their ideas.
So was it around this time that you started writing all the articles for Seeking Alpha and whatnot?
Yes.
As a way to sort of advertise your business? Was that part of the motivation?
I didn't really think of it in the advertising sense when I first started doing it. I really just thought of it in terms of feedback, because this was, it was official. The Capital Ladder advisory business was official, but it was still small. So my audience was small to the extent that I was selling research to a number of hedge funds, but we weren't talking about in the hundreds then. We were probably still talking about 20 to 30, which is good money, but it doesn't give me the feedback that I necessarily want from a really large audience. And so Seeking Alpha's platform gave you that really large audience.
Now you were rolling your eyes when I said Seeking Alpha. Is is that I know you were talking about the editorial policy with me the other day. You want to comment any further on that?
So I started writing on Seeking Alpha in 2012, and I developed a good following, a good track record and everything, and I stayed in my lanes, if you will. I only covered the companies that I understood and I thought were underfollowed or undercovered, and most of my analytics, played out as I said they would. Some of my earlier works were with SodaStream and with Keurig Green Mountain and with Target, and that's how I got my roots, if you will. And but some of the headwinds that I found with Seeking Alpha is the editors themselves. I found that there is a dedicated bias. Some editors are more lenient with what they're willing to publish and how quickly they publish works that are submitted by me. And others, especially when it came to writing about Apple, I had my worst experiences when it came to writing about Apple. I came from a different, they had never really seen anything written about Apple the way I was writing about Apple. And they really only have two editors that, I guess the way that they've set up the organization is only these two editors will, publish works on Apple. And so if they feel that your submission, your article needs work, that they'll give you feedback. But the feedback they were giving me, there was nothing I could glean from it other than either they didn't understand the content I delivered, or there's a bias. They don't want it published for a reason that only this editor understood. Now, having said that, I would push back, give them my reasoning why this is written this way, or here's the supporting material that says there's nothing wrong with the content, and then they would publish it. But I ran into that obstacle only and every single time I submitted a article on Apple.
Do you think they're on the payroll for Apple or something like that, or?
No.
Okay.
No, that doesn't happen.
Okay.
I just think that these particular editors were used to a certain type of content because they have only a few authors, that have proliferated articles on Apple for a number of years, so they were used to it.
And they're used to those guys.
Yeah. And mine just was very different. And then the other problem I had was when I started writing about volatility and my volatility strategies.
Okay, so if you could take me from shorting BlackBerry into to when you started getting interested in volatility as a main thing. I'm curious that period.
Yeah, one of our clients at Capital Ladder Advisory Group sent me the prospectus for ProShares, UVXY in particular. He wanted to understand this better, and I looked at it initially, and I read the prospectus, and I didn't get it. I just didn't understand why a fund, why an entity would create such a instrument that, in my mind, I understood was going to decay in value over time, and how that business makes money, and how exactly this correlates through transactions from the entire VIX complex. So I didn't understand it, and I basically kind of just brushed it off, and I said, to the client, this is going to take more work, but I will come back to it. There's just no way, without, in a week's time, I could actually figure this out. So I brushed it off, and I didn't come back to it until 2012. And, in 2012, he's like, he basically, it was kind of a, look, I really need to understand this better, and I can actually introduce you to some other, potential clients who want to understand this better.
Now, did they want to buy it as a hedge against their portfolio? Okay.
Yeah, they wanted to buy it
Okay.
long. They wanted to go long this particular VIX exchange traded product. But they weren't understanding why it was already decaying at a rather constant, pace. And they didn't understand, anything with regards to M1 or M2, Contango, roll yield, beta slippage. They didn't understand the Greeks or anything, with regards to trade. So, it literally, I would say it took me a good couple of months because you're not just reading this prospectus. The problem with some of these prospectus when it comes to VIX exchange traded products is that you have to be mathematically inclined. You also have to be able to think in the abstract. Because if you read the verbiage in the prospectus and you implement as the verbiage dictates, you're not going to do well. And I'm being generous by saying that. You're not going to do well. So you have to think about it in the abstract, and you have to be able to, draw a line from A, connecting it to point B, and understand what happens, in the transmission of these, correlations. There's a transmission, basically. I think about it, kind of like there's always a reaction. I think about it like a combustion engine. I turn on the car, and there's a reaction that goes on throughout the combustion engine cycle. And that's how the VIX complex is to me. I always say that for every action, there's a reaction of, and then there's a reaction of the reaction in the VIX complex. So anyways, long story short there, it took me a few months, but I was able to understand it conceptually. So I thought, I understood it in concept, that these products would decay over time. But it's easy to understand the concept. Then there's the actual practice, the actual implementation.
So coming up with some sort of strategy to make money based on what you figured out is what you mean.
Right. And that was trial and error, because even though I understood that over time, as long as the futures curve remains in upward sloping, that these instruments would decay. And when I say these instruments, I'm specifically talking about UVXY, TVIX, VXX, VIXY, VIXY, those particular instruments will decay over time. It's a whole other thing to actually start trading those instruments.
So what did you end up telling the guy that had asked for the research? Did you ultimately tell him, like, maybe you shouldn't buy it, maybe you should hold off on buying this particular one? Did you end up telling him that, or what did you end up saying to him?
I showed him, basically the existing, because there wasn't much history at that time, but, I showed him the history. I showed him what these are for. I sampled to him the VIX futures curve and what it would take for the VIX futures curve to invert and for him to make money on this from the long side.
So to get it to backwardation, sort of, and stay in backwardation. Yeah.
And, there was also just, what I expressed to him is, if you're getting in on the ground floor, that's generally never a good idea. If you just think about it from an IPO concept, unless this thing has been in existence for so long, or just has a extremely unique technology that would benefit mankind, getting in on the ground floor is generally not a good idea.
Okay.
And that's how I looked at this, and I gave him the full research report and everything, but again, the mathematics were really hard for just, even a pretty savvy portfolio manager would not understand involved here. You have square roots and all kinds of, things that you have to calculate in the Black-Scholes model and everything. So, I basically said, look, here's what we'll do. We set up a contract whereby, we would have an additional fee structure outside of, his subscription to our research, whereby I would actually start trading these. I would essentially take the risk.
Oh, wow, that's interesting. Which company was this for? This guy was working at.
I'm sorry?
Which company was this guy from? Oh, that's fine. That's fine.
Yeah, I'm sorry.
No worries.
But yeah, so that's what I did. And, from 2012 to 2013, I was up. I made good money on this, this early, commencement of trading and practice, but my strategy was not developed. There was no real strategy that had developed in that particular year. It really was a lot of trial and error, a lot of, just spreadsheeting and seeing what worked and what didn't, how long I had held, the particular instruments and things of that nature. And I lost the sight of the component, the major component. The major component that, kind of drives these things is the futures curve. And in order for that futures curve to look the way it does, it takes a particular economic cycle to maintain that equilibrium of the curve. I'm kind of trying to do my arms here, swooping upward.
I can add a graphic later with the curve in on the side somewhere. We'll make it look nice.
Yeah, so now I lost sight of that a little bit, but then 2013 it kind of came back into focus, and I started realizing that as this bull cycle is wearing on and paying that much more attention to the futures, the VIX futures markets, the M1, the M2, and how they're, transmitting a Contango factor, that's when it kind of all coalesced for me, or gelled. It all gelled for me, understanding that as long as you have some of the major components in the economic cycle producing positive earnings and a general, positive sentiment to the overall market, you're going to have an expression of complacency in the market. And we measure complacency or fear by the VIX. So, once I was able to kind of get that all working together, I understood that it was going to be optimal or beneficial for me to get more exposure to the volatility complex. So, in the beginning, I was only, trading, the 10,000 share lots, relatively, small lots, and, only holding for at most a week, at most. And realizing again, kind of going back to Starbucks, I was leaving tons of money on the table, and I was always chasing the stock down, the UVXY down. I was always chasing it down. Every now and then it had a little spike, which was great, but in general I was always chasing it down. So in 2013 is when I started to establish my actual strategy of holding a core position.
Now, did you know other people that were doing this at the time? Because it's a lot less popular than it is now. Back then, I would assume.
Yeah, I only knew a handful of actual hedge funds that were doing this, but they were doing it like I was doing in 2012, which was either not holding overnight or feeling like they were forced to hold overnight just because they were down and they needed to make that, they needed it to get to at least back to even. So I only knew of a handful of hedge funds that were actually doing it. I knew zero portfolio managers that were doing it, and the only ones that were participating in the volatility complex were using it as a hedge, a general hedge against their S&P 500 exposure. So yeah, in 2013 is when I basically said, okay, let's try this. I'm going to actually, and I set up my timeline to be 1 quarter, 3 months, where I was going to hold on to my position in UVXY and see what my returns were. And obviously the returns were fantastic. I didn't start elaborating, from that point I was able to start elaborating on that holding strategy, a core holding strategy, to where I would hold that as well as, trade in and out.
Trade around that, yeah.
Right, trade around that. And that was, later in 2013. I would say by 2014, I had a really well-defined strategy in place, and I was understanding the necessity of the cash component, which is my liquidity. Because the adverse reactions in the volatility complex and in these VIX exchange traded products are pretty extreme. And if you don't have a liquidity component for my strategy, you can obviously blow up your account.
So it's sort of like the opposite of the market crashing. When the market crashes, it has a violent move down, but this, if something goes wrong, it has a violent move up. That's the danger, is the violent move up. Is that right?
There's no limit to how high it can go.
So correct. So as far as I understand your strategy, you would keep a certain percentage of your total, like let's say 10% would be shorting the stock, and the other 90% would be cash on the side. Is it something like that you were doing?
Yeah, fairly close. Since 2013, it's been 20% core holding.
Okay.
And I would trade, roughly, 30% in and out, daily or weekly, maintaining, a good, in order to trade that 30%, I need a good 80% cash position. That takes a discipline also, because if this is going to be your core strategy as an asset manager, there's not much else you can do, because you need that liquidity, because you never know when that 200% spike can come, which it did in 2015. That was basically my strategy. I would keep a 20% core position on average, and trade about 30% of my cash, around that core religiously. And you can do that. You've been able to do that, I should say, because we don't know what the future will be. But you've been able to do that since 2012. It just compounds your profits by doing so. Sometimes I'll take my core position down, depending on what the geopolitical situation is, or what the macro fears are that are aligning the market at the moment. I might reduce it to 15% or so. But I would always layer it back on thereafter.
Now, if I can just play sort of devil's advocate for a second, what do you say to a person? Sometimes volatility will start to expand for a couple days, and on the chat rooms you'll hear a lot of people say, "Oh, it's a new day now. UVXY is going to turn around and start going up. It's going to be a bear market, and UVXY is going to start going up and stay in backwardation for a long period of time." What do you say when people say that sort of thing to you? Is that true?
I get that a lot.
Mm-hmm.
Whether it's from new clients of mine or on the chat rooms like StockTwits. I think that's a great forum. Or on Twitter. I get that a lot. This is a new era. It's going to stay in backwardation. One thing I don't think people appreciate about the equity markets, okay, because that's what we're talking about. We're still talking about the equity markets. Is if you go back in history, the equity markets can only exist in a heightened state of volatility for very short periods of time. That's no more better evidenced than in the 2008, crash cycle, which lasted all of 4 or 5 months, where volatility just shot all-time highs, and quickly thereafter came back down, because the markets just can't exist in a state of panic for an extended period of time. They will kind of tumble upon themselves, or the government has to step in and remedy the situation, which again,
we lost each other. We lost each other here for a second, I think, with the connection.
are we here? See me?
Yeah, we lost each other for a second with the connection. Let's see. I think we're back. Yeah, you see me? Yeah, I can see you now. I lost you when you said, when you started saying the government would have to step in if there was a...
Yeah, So yeah, I'm basically saying that these periods of volatility, backwardization, or just hyper volatility in the market can only exist for brief periods of time, because otherwise the equity market would kind of collapse upon itself. And that's basically what we saw in 2008, is the government or the central banks stepping in to calm the markets down, and volatility just collapsed on itself. It just decayed, from that point on. So what I say to people like that is, please go back and revisit 2008. Because a lot of people conflate a bear market with the futures curve being inverted, and that's not necessarily a one-to-one correlation, because the market can go into a bear cycle. It can definitely go into a bear cycle, whereby volatility will gravitate higher. But once it reaches that level that it's comfortable with, or that mean average, if you will. So right now, I think this year we're going to be below 15, right? The VIX.
Yeah, most definitely. Maybe below 13 even. Yeah, it's a yeah.
It's just remarkable. But let's say we go into a bear market, and it jumps up to 15, 17. Let's say it jumps up to 17. As the market starts to accept, that the S&P and the Dow and the Nasdaq are going to gravitate lower, maybe through the course of 12 months, it doesn't necessarily mean that volatility will graduate higher or gradually increase higher. Volatility, once it reaches its point, its peak, if you will peter out, and then you're still stuck with the construct of these products, which relies very heavily on the relationship of the M1 through M7.
Well, I can uniquely speak to that, because in 2001, I lost a ton of money being long volatility in a down market, because, like you said, once it started, just going sideways, a lot of the market players left, and so there weren't as many options, even traders. And just because people haven't experienced a bear market doesn't mean when that happens, the world's going to turn upside down as far as the term goes, it seems.
In a very orderly fashion. They really can. I mean, you can lose 0.5% a day, a week. It can be very orderly, and there's just not a lot of volatility in that environment. Where you just have people taking down positions in an orderly fashion. The other thing that people, I hear a lot is sometimes, the fund itself is going to blow up. If we get 100% spike in the VIX in one day. And what they also don't realize is that most of these instruments capture only about 50% of the VIX move. And that's just on the first month, the nearest month, M1. You've got to capture that in both M1 and M2. The likelihood of that happening is just so very minimal. I'm not saying it can't, but that's the reality of the equation, if you will, is that in general, the futures contracts are only going to capture half of that volatility.
What about this one? I hear this one a lot. I can kind of imagine how you might respond to it, but volatility is very low right now. This is, should you really be selling volatility when the VIX is low? VIX is below 10. How do you convince people that this strategy works when volatility is low? I guess people say that because they don't understand the nature of the term structure, I believe, but do you get...
I would say there's never a bad time. That sounds a little salacious. There's never a bad time to start a position in a VIX exchange traded product, as long as you have time on your side. And the way keep time on your side is through making sure you have liquidity. However, investors should think in terms of probability. You always hear people say, "What's the possibility?" I don't care. Anything's possible. What's the probability? That's how I handle money. What's the probability of me making money on this trade or me losing money on this trade? So what I would say is you want to stack the deck in your favor. So the best way to position is when you get an uptick in volatility that also, has a corresponding uptick in some of the, VIX exchange trade, UVXY or TVIX. It's not optimal to chase a, UVXY down. It's always best to, get it on a spike. But again, having said that, since, these products have commenced trading, you've always, if you've held on to your short position, you have found a profit.
I think people from beginners in volatility products to people who actually actively trade it every day and who are real traders of it can get something out of what what you've been telling me right now. And I find it fascinating how you were able to sort of key in on that. A client asks you to research this one product, and you key on in this huge opportunity. It seems all very obvious now that, of course it's going straight down. Of course we should short it, but we didn't figure it out. You did, and it wasn't so obvious. It seems obvious after the point, but you were the one who was able to actually put it together, on your own, which is amazing.
Our conversation and the general participation with these instruments, I feel a little bit of an obligation to also, kind of inform those who are newly participating, with the volatility complex and these derivatives, that, markets change. Markets are, always going to change. One of the, through this journey in my, financial market career, one thing that I've always tried to do is expound on my, what I know. So, I've kept learning, and I've kept, experiencing other, aspects of the market. I think I have a decent handle on, U.S. markets and U.S. volatility, but I also like to do, experience, the European markets and what their volatility market and derivatives are like. And at the same time, a word of caution, this is not for everybody. It really isn't. But if you do want to learn, there are resources out there.
I just lost you again for a second. It's okay. I got most of it, I believe. So yeah, you still are active with individual retail stocks, I've noticed. Is that the majority of your focus, the volatility products though now? Or are you expanding back into retail?
No, I would say I've always been, an equal opportunity offender with these products, with these categories, if you will, or market segments. I still participate in retail, trading it and owning it. To be quite honest, the only retail stock that I've owned long term was Costco. I had bought that in late 2016. I had done a whole research report on it, sent it to my clients, and we bought it back in I think it was November of 2016 in the 150s, and we were able to sell it this year in the 180s.
Oh wow!
Plus, we got the one-time special dividend of $7 per share, which was awesome.
Oh, nice.
So did really well with that. But yeah, I still produce analytics and research and articles for the retail segment. Some of the ones that I follow more religiously are Target, Macy's, Kohl's, JCPenney. Those are kind of my favorites, if you will. And to the extent that over the last several years I've been writing these articles, much of what I've kind of spirited in these articles has come to fruition in last year in October. And so in 2016 2016, October 2016, before the hurricanes were gonna, come on shore in Florida. I had written this piece that one of my hedge fund clients, picked up, and he was on CNBC, and he also is published in Yahoo. And he put my name in there, and he basically said, well, Seth Golden doesn't like the way that the retail numbers are looking, so we're taking our exposure down from our retail stocks. And you obviously...
Right before the hurricane, huh? Perfect.
Here in 2017, you've seen what has happened to all of these retail names.
Yeah.
And it was just, everything that had been seen in the way of foot traffic in stores, just the trending same-store sales problems, and the inability for these companies to kind of course correct, and produce more positive results. I thought it would take them a good year to figure it out, at least a good year to figure out, and some of them still haven't.
I'm amazed the way Foot Locker's actually come back, the stock. I thought that was like dead in the water, and it's come back a little bit lately. Yeah, right, exactly. I just have to ask you, what do you think of Bitcoin and all the cryptocurrencies? Because everybody's talking about them these days. Do you think it's worth investing in those?
When I don't understand why something is valued in the manner that it is, and Bitcoin is valued in a way that it's really a complete offset of supply, or it's an offshoot of the supply. So, when you have such a rare supply and such controlled supply, it elevates the price. And then you just have this dynamic. And you really.
Oh no, I think I lost you again. All right, you're back. I'm sorry. If you could just repeat the last sentence, I lost you again. I'll have to edit it out.
Basically saying the fundamentals of Bitcoin are still unknown. And the correlation of the value is derived from, basically from the control of the supply. There's a lack of regulation, obviously, and I know people, are tired of hearing about the lack of regulation and, how the blockchain is the biggest asset. But we really don't fundamentally know how the two work together in a mass market.
Yeah, I agree totally. It's like, I have no way of valuing it personally, but it's like, what's the logical conclusion? It just becomes so valuable that it takes up every dollar in the world, and it's, where does it all end here? It's got to end by going down at some point, I would think. I don't know.
The way that I think we can use, digital payment systems as kind of the onset of PayPal, and then you had Apple Pay. Now everybody has their own payment platform. MasterCard, Visa, they all have these digital payment platforms. So far as an actual currency, people have tried. This is, Bitcoin isn't the first, attempt at a new currency. It's not. Every single other, attempt has failed. Every single, payment platform has not resulted in changing the behavior. This is what people don't really, think about is, in order to change or implement, mass scale Bitcoin and blockchain, you have to change human behavior. They've been able to do that. They said with your digital wallet, you would do away with credit cards. They've been saying that for, 5-6 years.
Meanwhile, MasterCard and Visa have been the real winners, it seems like, for a long time.
It's just not even close. Why? Because there's a security in having that physical card, that physical piece of paper, that dollar bill, or that quarter in your pocket. There just is that sense of security. So I just don't see how you're going to change human behavior to adopt blockchain and Bitcoin, functioning within, That's your obstacle. You know, it's kind of it's the same way I think about some valuations and other stocks out there, like Tesla. You got me. I mean, if you're telling me that this company is really worth $350-$400 a share, you will never get me to understand that. Why? Because you're essentially saying at your price point, Mercedes is wrong, and so is BMW. You're saying that you can mass scale it where Mercedes and BMW have never been able to, and make a product and make a profit using the technology that you do, which is above and beyond a combustion engine. When it comes to valuing, whether it's currencies, volatility, or just your basic equity, it all comes down to fundamentals, and I just can't see the fundamentals in Bitcoin.
Yeah. Yeah, one of my risk managers once said, and there's a little bit of truth to what he said, that is the stock market is a big popularity contest, to a little bit, and Tesla is just the pretty woman at the moment,
I agree. People complain about the valuation on Facebook. They're like, well, look at Facebook's valuation. I said, yeah, but Facebook has demonstrated the ability to mass market, adopt mass consumption of its product,
sell advertising,
drive a profit, and change human behavior. They've done all of that, so it deserves the valuation it gets. Probably even more if you want to juxtapose it with Tesla. But yeah, I mean, it's tough. That's the hardest part of the analyst business is assigning valuation. That's always been I don't think there's a single analyst out there that would say, his job, begins and ends with value. And how do you value something? And that all comes from the metrics and in what you believe. We're a consumer-driven market. It all ends with the consumer. And Facebook figured out how to change human behavior and profit from that. It's just remarkable in my opinion. I own Fitbit. I own Fitbit actually, but I owned Facebook for 2 years. And I had almost doubled, the value of the capital that I deployed in Fitbit for my clients.
Nice.
And the reason was I saw the change in human behavior. You could see it, you could feel it, you could see them monetizing it every single quarter. So until I see that from the likes of Tesla, I could never invest in that, in the valuation where it is. And I'll miss the boat, yeah. I'm honest, I missed that obviously, but like you said, it's a popularity contest. I just didn't find it, popular.
Yeah. I mean, I have so many friends that don't trade the stock market but have made money in Bitcoin and those things and give me a hard time. But I know the minute I buy it, it's going to go straight down from there. I'm convinced of it.
Yeah, exactly. I keep seeing it go up and up and up, and I understand from a supply, a demand-supply equation that it kind of should.
Right, especially with it being listed on all these exchanges and stuff and everything. But
the CME is going to have, Bitcoin future.
Yeah.
So if you're actually going to be able to short this, what is that going to do, to the valuation of Bitcoin? Is that going to, kind of level the playing field, or
it'll be interesting. Yeah.
A groundbreaker there.
No, yeah, it's too scary for me also. Well, listen, I think we should probably quit while we're ahead with this connection here, and I really appreciate you, you spending a little time with me. Some of the questions I asked you, I sort of knew the answer to, but it's kind of nice to have. It's actually kind of nice to have, sort of your history all in one spot, because I think a lot of people know that you've been very successful, but they don't really know how that came to be. And it is an amazing story too. I mean, it's an American story,
Yeah, I appreciate the opportunity. I think you're doing a great job. I've seen a few of your other videos, and I had you're a really great guest, and hopefully I can come back at some point in the near future.
Yeah, anytime, and I love talking with you online all the time. So Great luck today. Let me check. Yeah, we're still okay on UVXY.
I think they're at almost the lows of the day. So
That's perfect.
good job of, keeping to the script and away from the visuals.
Right. Otherwise, we probably would have been, if it had spiked again to 17 right now, we probably would have had to run away for a second. Well, we probably shouldn't. We shouldn't have to, but sometimes we're not as calm.
Hoping to put in some limit orders.
Yeah, exactly. All right, Seth, well, nice to talk to you, and I will talk to you online later today, I'm sure.
All right, you have a great one. Take care.
Hey, thanks, bud.